Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Thanks for joining us for our September 15th, Thursday edition for Market Insights and Observations. Markets are in a struggle right now. Bulls and bears are going at it as we are in the heels of economic data. In fact, in my conversation yesterday with Bloomberg Radio, and the link is below, so I encourage you to listen to that interview yesterday afternoon. I basically recapped sort of our thinking at Blanke Schein Wealth Management, our positioning, and also where we see opportunities moving forward, so I encourage you to listen. But a recap of that, in a sense, was markets are basically struggling through the data and interpreting what the Federal Reserve is talking about doing, and next week, ultimately, what the expectation is for the Federal Reserve. We believe and we anticipate that the Federal Reserve will raise interest rates 75 basis points. It's expected. And in fact, their credibility is on the line at this moment in time. And now, why is that so important? Because the consumer price index came in hotter than expected earlier this week on Wednesday. And then Thursday, we also have the PPI that also came in sort of a little bit lighter. In fact, what a good news is on a peak finished goods, the PPI, that inflation number has come in. So it's gone down. And that is one of the sort of the front end on the manufacturing side indication that inflation tensions could be easing. So the question is, are we in peak inflation, and is there peak hawkishness coming a little bit later after the Fed does their job next week? It really have to look to October. October, we're going to get the employment data, because if you recall what the Fed said is they're going after the job market very specifically, because that's where the wage inflation is. That's where it's embedded in inflation. And as wages rise, they have to also keep up with the housing, right? And so shelter is rising. In real estate, it's coming down. On the real estate side, we're seeing some positive movement in terms of the real estate market cooling off a little bit. That's what the Federal Reserve was clearly targeting. We saw that in the mortgage market. Remember, the mortgage rates went from 3% to now 6% in the few short, 8 or 9 months started this year. So it's a really big blow or pump on the brakes in terms of the mortgage market. That's hitting housing. Now rents really take about 18 months to follow. So we won't see rents subsiding in terms of the inflationary pressures within there for quite some time. In the middle, we're looking at the jobs. Jobless claims came in today, sort of in line with expectations. It's October. The first week in October, as I referenced in the Bloomberg Radio report, is after the Fed. That's the most important sort of economic data that we're all going to be waiting for, specifically the markets and the Fed. And we're looking for the JOLTS number, the job openings number, to go down. And so that's the job openings. Remember, there's 2 jobs open for every 1 employee working right now. And that's what keeping our unemployment rate down below the 4% level. Federal Reserve wants to make certain that they close that gap, so they're going to take down the job openings opportunity. We're already seeing it in the headlines of sort of corporations are laying off because of some of the inflationary pressures within, or even slowdown on the front end in some companies. Now, we're seeing a rolling recession through corporate balance sheets, and we'll get more clear indication of this in the third quarter as we get into the third quarter reporting season and see how the corporations actually fared. But in the meantime, where are we on yields? Well, the 2 and the 10s, the 2-year Treasury and the 10-year Treasury. We talk about the 10-year Treasury all the time. In fact, if you look at 1 year ago today, the 10-year Treasury at 1.29%. Today, we're at 3.45%. That's a significant rise in the 10-year Treasury. But what's even more significant is the shorter end of the yield curve. The 2-year Treasury is, a year ago, was less than 25 basis points at 2.1%. Or 0.21%, excuse me, so less than 25 basis points. Now we're at 3.87, and so 3.8 for a 2-year piece of paper is not bad. We're actually being more encouraged on the fixed income market. We're becoming more constructive. Again, I said that in my Bloomberg report. As soon as we see the Fed peak, with regards to, or inflationary pressures peak, that means that the Fed's going to have to roll over and pause on their initial sort of rate hiking sort of cadence, or even reverse course maybe next year, as we could see signs of a growing recession within the United States. So they have to thread the needle, being the Fed. They want to bring down the jobs opening. They want to increase the unemployment rate just a little bit. That'll ease some tensions here, and that hopefully then will bring down the ultimate goal of inflation, bringing the Fed's target from where we are to the 2% target as they're going. Right now, we're in the 8% for inflation. And I always talk about kitchen table economics. What you and I spend money on is even more than that. But on the flip side, once we see this, and there's some great data that supports, once you see peak inflation, markets 12 months following that, let's say all signs clear ahead, markets are up. Since 1940, the actual empirical evidence is, and the data supports it, that that's when you want to buy. You want to buy peak inflation. Happens to have inflation on the CPI reading 6 times above 6% since 1940. And when we got the inflation peak, looking back 12 months, moving forward, the markets were up all 6 times, and 4 of those actually even handed us a recession. So we could still have markets go up in the middle of a recession or even an impending recession, and it's all based upon inflationary pressures within the economy. So stay tuned. That's what we're paying attention to. This is what markets are struggling with on the bulls and the bears every single moment. But we're on top of it, and if you have any questions here, we're here for you at Blanke Schein Wealth Management. Thanks for watching, and we'll see you again next time.